Alright folks, grab your coffee, or maybe something stronger, because we need to talk about China. The big red machine just dropped its Q3 report card for 2025, and on the surface, it's all smiles and high-fives in Beijing. The headline number? 4.8% GDP growth. Beat the nerds on Wall Street, who were betting on a little less. The official statement from the National Bureau of Statistics practically popped the champagne, saying this lays a solid foundation to hit their around 5% target for the year. The markets, ever the optimists when there's a buck to be made, ate it up. The CSI 300 index in Shanghai jumped 1.3%. The Hang Seng in Hong Kong popped 2.5%. President Trump, in a rare moment of chill, signaled he might be easing up on the trade war rhetoric, and suddenly everyone's singing Kumbaya. But you and I, we don't just read the headlines, do we? We're here at Boss Economic World to look under the hood, to kick the tires, and to see if that shiny new paint job is covering up some serious rust. And let me tell you, folks, what we're seeing isn't one economy. It's two. We're looking at an economic chimera, a paradox of fire and ice, all crammed into one country. So today, we're going to dissect the beast. We'll uncover the truth behind the 4.8% number, explore why your average person in Shanghai or Chengdu might be feeling a whole lot poorer than the data suggests, and figure out what this high-stakes game of chicken between Trump and Xi really means for your portfolio and the world. Let's restore the full picture. First, let's give credit where it's due. The number is 4.8%. It's not a fake number. But it's a number that hides more than it reveals. Think of it like this: you've got a car with a jet engine strapped to the roof, but the four wheels are wobbly and one is completely flat. Is the car moving forward? Yes, technically, and at a pretty good clip. But is it a smooth, stable, or sustainable ride? Absolutely not. The jet engine, in this case, is China's industrial output. It roared to life in September, expanding 6.5%, blowing past every single economist's estimate. It's a monster. This is the part of the economy that gets all the state funding, all the political attention, all the 5-year plans. We're talking about what Beijing calls the new 3, electric vehicles, EVs, lithium-ion batteries, and solar panels. And the numbers are staggering. In the first 3 quarters of 2025, China has exported over 2.2 million EVs. That's more than Germany and Japan combined produce for their own markets. Brands you'd barely heard of 5 years ago, BYD, NIO, XPeng, Li Auto, are now clogging the ports of Rotterdam and landing on the shores of Southeast Asia and South America. The BYD Seal is now the best-selling sedan in Brazil. Their solar panel output is so vast, they could single-handedly repower the entire European continent in about 3 years. Their production capacity for solar panels is now 150% of the entire rest of the world's combined. This is what's keeping that headline GDP number afloat. It's a tidal wave of manufactured goods, a state-sponsored export blitzkrieg designed to dominate the future of green tech. And it's working, for that part of the economy. This is the fire part of our fire and ice economy. It's hot, it's powerful, and it's what the government points to when it says, see? Everything is fine. But while that jet engine is screaming, the rest of the car is falling apart. This brings us to the ice. Let's look at the parts of the economy that actually reflect how the 1.4 billion people inside China are feeling and acting. First, retail sales. The official number says they grew, but at the slowest pace since November of last year. What does that mean in plain English? People aren't buying stuff. The shopping malls are quiet. The online carts are full, but the checkout button isn't getting clicked. This isn't a blip, it's a trend. The reason is simple: the great Chinese housing market crash of 2022 to 2024 destroyed the single biggest source of wealth for the Chinese middle class. For 2 decades, people believed buying a second, third, or even fourth apartment was a can't-lose investment. That illusion has been shattered. The wealth effect has gone into reverse. People feel poorer, so they're saving every yuan they can, terrified of an uncertain future. They're practicing what the kids on Chinese social media call lying flat or frugal living, but it's not a lifestyle choice, it's a necessity. But the truly scary number, the one that should be setting off alarm bells from Beijing to Boston, is fixed asset investment, or FAI. For the first time since the world shut down in 2020, this number has contracted year-to-date. Let me break that down. FAI is basically the economy's investment in its own future. It's companies building new factories, developers building new buildings, and the government building new bridges and roads. When this number goes negative, it's the loudest possible signal of a vote of no confidence from the people with the capital. And when you dissect that FAI number, it gets even uglier. 1. Real estate, the slump is still the main driver. It's a zombie that just won't die, and it's dragging everything down with it. No one is building new apartments because there are already enough empty ones to house the entire population of France. 2. Infrastructure, this used to be China's secret weapon. Got an economic slowdown? Just build a few more high-speed rail lines and a dozen new airports. But that playbook is exhausted. Infrastructure investment grew a pathetic 1.1% in the first 3 quarters. The low-hanging fruit has been picked. They've run out of useful things to build, and the mountain of debt from past projects is coming due. 3. Manufacturing investment. Even here, in the supposed engine room of the economy, investment has slowed from a nearly 10% expansion rate earlier in the year to just 4%. Companies are pumping out goods from existing factories, but they are deeply hesitant to spend big on building new ones. Why? Because of the dragon in the room. And that dragon's name is deflation. This is the most insidious, most dangerous, and most misunderstood part of the entire Chinese economic picture right now. The official GDP is real GDP, meaning it's adjusted for inflation. But let's look at nominal GDP, which isn't adjusted. Think of it as the actual amount of money sloshing around the economy. Nominal GDP growth slowed to just 3.7% in the third quarter. Now, do the math. If your real growth is 4.8% but your nominal growth is only 3.7%, what does that tell you? It means that prices, across the entire economy, are falling. The GDP deflator, a broad measure of prices, has now been negative for 10 straight quarters. A full 2.5 years of deflation. This is the longest deflationary streak in China's recent history, and it is an economic cancer. Here's why it's so deadly. For companies, why would you invest in a new factory when the price of the goods you produce will be lower next year than it is today? Your profits get crushed. Competition becomes a brutal, price-slashing war to the death, as we're seeing in the EV market inside China, where companies are torching cash just to survive. For people, why would you buy a new car or a new TV today if you know it will be cheaper in 6 months? You wait. This waiting game freezes consumer spending, creating a vicious cycle. For debt, deflation makes debt heavier. If you have a 1 million yuan mortgage, that 1 million yuan is fixed. But if your salary and the value of your assets are falling, that debt becomes a much bigger burden. Deflation is a silent killer. It suffocates an economy from the inside out. And China is deep in its clutches. This is the ice. So you have this paradox: the external-facing, state-backed export sector is on fire, while the internal, domestic-facing consumer economy is in a deep freeze. This isn't a bug in the system, folks. This is a feature of China's development model. When your own people won't or can't buy the stuff you're making, you have only one choice: sell it to the rest of the world, even if it's at rock-bottom prices. And that, my friends, leads us directly to the geopolitical drama. This week is massive. You have the fourth plenum, a secretive meeting where China's top leaders will map out the next 5 years. And you have Treasury Secretary Scott Bessent flying to Malaysia, a neutral ground, to meet with Vice Premier Hou Lifeng. This isn't a friendly chat, it's two prizefighters setting the rules of engagement before the main event, the inevitable meeting between President Xi and a re-elected President Trump later this month. And what did Trump just list as his top issues? Rare earths, fentanyl, and soybeans. This isn't a random shopping list. It's a coded message. 1. Rare earths, this is America saying, we know you control the supply chain for the future of technology, from our F-35 fighter jets to the very EVs you're trying to sell us. Don't think we've forgotten. It's a direct challenge to China's tech dominance. 2. Fentanyl, this is a domestic political issue for Trump, but it's also leverage. The US is accusing China of not doing enough to stop the flow of precursor chemicals. It's a way to paint China as a bad actor on the world stage. 3. Soybeans, this is the olive branch, the carrot. It's Trump's signal to his own farming base that he's fighting for them, and a signal to China that there's a deal to be made if they buy American agricultural goods. Put it all together, and the US position is clear: we are not going to sit here and allow your state-subsidized industrial machine to solve its domestic deflation problem by flooding our markets and hollowing out our own industries. The first trade war was about tariffs on washing machines and steel. This new, brewing conflict is about the commanding heights of the 21st century economy: green tech, biotech, and AI. China's view is the mirror image. They see their new three as their rightful path to high income status, and they see America's complaints about overcapacity as nothing more than protectionism, a superpower trying to pull up the ladder behind it. This is the backdrop for Beijing's policy response. And if you're expecting a bazooka, you're going to be disappointed. So, facing a frozen domestic economy, what is Beijing doing? Last week, the Ministry of Finance announced it was allowing provinces to use 500 billion yuan, or about $70 billion, in unused bond quota. The media reported this as fresh fiscal support. Let's be clear about what this is. This is not a giant stimulus package. This is like finding some forgotten cash in your winter coat pocket. It's letting local governments, which are already drowning in debt, use a bit of their remaining credit line. And what can they use it for? The official statement says to reduce off-balance sheet borrowing, i.e., pay back old, hidden debts, repay money owed to companies, i.e., pay their bills, and only 4 qualified provinces to expand investment. This is a debt cleanup operation disguised as stimulus. It's a financial plumbing job, not an economic rocket booster. Economists like Jacqueline Rong at BNP Paribas are hoping it might lead to a rebound in infrastructure investment in the fourth quarter. But it's a hope, not a guarantee. It's a band-aid on the deep wound of collapsing private sector and consumer confidence. Why aren't they doing more? Why not just give cash to people, like the US did during the pandemic? Because that goes against the core ideology. The focus is, and always has been, on the producer, the state, the supply side. Giving money to consumers is seen as wasteful and ideologically impure. They'd rather build another bridge to nowhere than give a family 5,000 yuan to spend, because the bridge adds to GDP, while the family spending just gets consumed. So here we are. October 2025. China is on track to hit its 5% growth target. And it might be the most misleading economic statistic of the year. The full picture is one of a deeply divided economy. There is a China, the state-backed, export-oriented, high-tech manufacturing powerhouse. It's running hot, gobbling up global market share, and locked in a strategic battle with the United States. And then there is China B, the domestic, consumer-driven economy of 1.4 billion people. It's stuck in a deflationary deep freeze. The property dream is dead, confidence is shattered, and people are hoarding cash. The government's current strategy is to use the fire of China A to keep the whole machine moving forward, while doing just enough plumbing and patching to prevent China B from completely seizing up. The big question, the one that will be debated in secret at the 4th plenum this week and will shape the 15th five-year plan, is whether this is sustainable. Will President Xi finally listen to the voices calling for a radical rebalancing of the economy toward domestic consumption? Will they finally put the Chinese consumer, not the state-owned factory, at the center of their economic model? This is the trillion-dollar question. One path, the path of rebalancing, could mend trade imbalances and lead to more stable, sustainable growth for both China and the world. The other path, doubling down on the current model, inevitably leads to more trade wars, more accusations of overcapacity, and mounting social and economic pressure at home. The official numbers tell you the patient's temperature is a healthy 4.8%. But they don't tell you that one half of the body is on fire, and the other half is freezing to death. That's the real story. And you can be sure we'll be watching to see which medicine they choose to prescribe. Until next time, keep your eyes on the money, and don't just read the headlines.